Very good evening, learners. Welcome to today's session. I am Dr. Neha Seth, working as an associate professor with School of Management Studies, Indira Gandhi National Open University. And today I am going to continue my previous session wherein I discussed cost of capital with you all. So in our previous session, we started with a very basic thing. We started with the definition of capital. We understood what do we understand by this term called capital. Then we moved on with the understanding of what is cost of capital. So we learned that why cost of capital is important, why it is important to calculate cost of capital, and how it helps cost of capital in managing our business efficiently. There were three reasons because of which it is important to calculate cost of capital. Because first, it is helpful in taking the investment decisions. Second, it is helpful for us in calculating our capital structure to know that what is the ideal capital structure for us. And the third one is to know the efficiency of top management, whether the top management is able to make business operate above the basic break-even point level or not. So these were the reasons why understanding of cost of capital is important. And we moved on with discussing the sources from where the capital can be gathered. So we talked about the basically four sources where the capital can be gathered: from debt, from equity, from preference shares, or from retained earning. Then there is a possibility that we can calculate individual cost of capital for each one of these. So we started with learning of cost of capital for debt. And then we also learned calculating cost of capital for preference shares. So while calculating cost of capital for debt, we learned that how we can calculate cost of capital for redeemable debt and for irredeemable debt. Similarly, in the case of preference share also, we learned that how we can calculate the individual cost of capital for redeemable preference share as well as for irredeemable preference shares. So these were the two individual cost of capital that we have learned in our previous session. And today we are going to continue the session with learning of individual cost of capital for equity. So we will learn that how cost of equity can be calculated. Okay. So you can see on your screen there is a formula for the case when there is zero growth rate. Now suppose the dividend that the company is paying is not increasing at all. That means a fixed amount of dividend the company has declared, and the same amount of dividend is going to be distributed among shareholders year after year. So there is no growth in dividend as such. So in this case, we are going to use this formula where our cost of capital, which is represented by KE, will be calculated by dividing dividend D1. D1 means dividend declared at the end of first year. It has to be divided by P0, that is the value of share. Okay, using this formula we can calculate cost of equity when there is no growth rate. Then there may be the case when the growth rate is constant. That means when the dividend is growing at a fixed percentage, at a fixed rate year after year. Suppose the growth rate of dividend is 10%. And in first year, the dividend declared is rupees 10. So next year, the dividend will be 10 rupees plus 10% of 10 rupees. That means 11 rupees. So the dividend is growing at the fixed rate. So if this is the case, in this case, we can calculate our cost of equity using this equation, where PO is value of the share and D1 is dividend declared at the end of first year. KE is the cost of equity. This is what we need to calculate, and we need to subtract the growth rate out of this. Now by adjusting this equation, like what we can do, we can take KE minus G in numerator on left hand side and we'll get the value of D1. In this case, then KE minus G will be equal to D1 upon P0, and we need to calculate KE, which is equal to D1 upon P0 plus G. So by utilizing this equation, by arranging this equation, we will reach to this equation wherein we can calculate the value of KE, which is equal to dividend declared at the end of first year divided by price of share, value of share plus growth rate. So this is the formula we can use when we have constant growth, or we may also call this dividend growth method. Then we have one more formula, and this is the case where the growth rate is varying. That means the growth rate is also changing with time. Okay, so first year the growth rate may be the 10%, the dividend is growing at the rate of 10%. Next year the dividend growth rate may be 12%, and further in coming years the growth rate is also changing, maybe increasing or it may also decrease as well. So in such case we have to use this formula where our KE can be calculated by dividing our dividend proportion by price of the share, and we just need to add the growth rate to this. And then there is a fourth case when there is no dividend given at all. That means zero dividend method. Okay, in this case no dividend is declared, and in this case again we will start with the value of share, and this value of share at the time of maturity has to be divided by 1 plus KE raised to the power n. Okay, and again we just need to adjust this equation to reach to our formula. So in this case also our P0 we will multiply it by 1 plus KE raised to the power n. We will take this value in the numerator on left hand side. So by this we will get the value of Pn, and then what we can do, we can keep it here only on left hand side. Pn will be divided by Po, and for 1 plus KE raised to the power n are, no, we will not use n here. Pn by Po will be, we need to calculate under root, nth root of this part, and then for KE we will have Pn by Po, nth root of this minus 1. So this is how from this equation we can calculate this equation, which is our formula when the growth rate is, when the dividend declared is 0. So this formula is used when there is zero dividend. That means zero dividend method is used. Okay. Then we have one more method wherein we can calculate cost of equity. Okay, this is called capital asset pricing method. Okay, we also call it CAPM. Now there is a quick equation for this wherein KE, cost of equity, can be calculated by using this risk-free rate, which is represented by RF. We just need to add our beta of investment, that means the systematic risk. Okay, and this portion is our risk premium. And how we can calculate risk premium? By subtracting risk-free rate from the market rate. Okay, so by using this equation we can calculate KE, that is cost of equity, using CAPM model, that is capital asset pricing model. Okay, so now let us try and understand this calculation with the help of one numerical, a practical example. Now see, this is a company, and this company pays a dividend of rupees 20 per share in this case. Okay, and the dividend is expected to remain same. The current market price of the share is rupees 125, and we need to calculate cost of equity in this case. So this is the case of zero growth rate, because no growth rate is given in this question. Okay, so the solution will be like this. Immediately we will use our very first formula when the growth rate is considered as 0. So in this case our P0 is equal to dividend divided by cost of equity. Now since we need to calculate cost of equity, we will adjust our equation. We will take KE on left hand side and PO as denominator on right hand side. Now just we need to substitute the values which are given to us. So our dividend that is declared in this case is 20 rupees. Our value of share is 125 rupees. So 20 divided by 25, that is 0.16, or this can be written as percentage form as 16%. So in this case, when the growth rate is 0, the dividend growth rate is 0 or no growth is there. So in this case, our cost of equity is 16%. Okay. Now let us see one more example when our growth rate is constant. That means our growth rate is fixed. Dividend is growing, but growing at a fixed rate. So we'll see this with the help of this example which is available on the screen. Now if the dividend per share of the firm is expected to be rupees 15 per share. So this is the dividend amount. Now next year this is expected to grow at 10% constantly. So the amount is, this dividend is growing at the rate of 10% constantly. Now this statement clearly shows that this is the case where of our constant growth model, when dividend is declared and it is growing at the constant rate of 10%. We just need to determine the cost of capital here. Cost of equity if the market price of share is rupees 50. So the value of share is also given to us in this case. Now let us see how we can solve this question and we can calculate the value of equity, cost of equity in this case. So we will use our formula, okay, wherein our KE can be calculated by dividing 15 by 50. Now what is 15? 15 is dividend amount, okay, and 50 is price of the share plus 10%. 10% is our growth rate. Now by solving this equation, we get this KE value as 40%. So in this case, when our dividend, which is declared at the end of first year, is 15 rupees, the price of the share is 50 rupees, and the growth rate is 10%. So if this is the case, then our cost of equity in this case is 40%. So this is how we can calculate cost of equity when there is constant growth rate. Now let us see one more example of CAPM model, capital asset pricing model. Now this company, a company wishes to calculate its cost of equity using CAPM model. The risk-free rate of return is 10% in this case. So RF, risk-free rate of return, is given as 10%. Firm's beta is 1.5. So beta is our systematic risk factor. So this represents systematic risk. And the return on market portfolio is equal to 12.5%. That means our RM is 12.5% and our RF is 10% in this case. Our beta value is 1.5 in this case. We already have this equation with us, that how we can calculate KE, that is cost of equity, using capital asset pricing model. So we can calculate this by placing these values in our equation. Okay, so our RF is 10%, our beta value is 1.5, market return is 12.5%. We just need to subtract RF, risk-free rate, from market return to get risk premium value. This risk premium amount will be multiplied with 1.5. We just need to add 10% to this and we will get this value, that is KE, which is equal to 13.75%. So if this is the case where we need to calculate cost of equity using CAPM model, the market return, risk-free rate of return and systematic risk factor is given to us. So in this case, our cost of equity is 13.75%. So this is how we can calculate our cost of equity individually. Okay. So let us move on to the next source of funding, that is cost of retained earning. Now what is cost of retained earning basically? Retained earning is something, it's that portion of profit which is kept aside, which we are keeping aside. We are not distributing in the form of dividend to our shareholders. We are just keeping it with ourselves so that we may utilize it whenever it is required. So we may also use it for the purpose of investment so the company can grow in future. But since it is a part of profit, this is something we are retaining with us. But is it free? Again, the answer is no. Of course, it is also not free. We are bearing some cost for retaining our earnings with us as well. Since we don't need to pay interest in this case. We don't need to pay any dividend. We are not sharing our profit in this case as well. But still it is not free. There is no implicit cost of capital for retained earnings. But the capital reinvested in the company is not free. So how we can calculate cost of retained earning? What rate, what amount we can consider as cost of retained earning? So in this case, cost of retained earning is cost of equity. Okay, so what we will consider, how we will calculate cost of retained earning. We are not supposed to calculate cost of retained earnings separately, but when we are calculating cost of equity, the same cost of equity will be considered as cost of retained earning. So our KR, that is cost of retained earning, is equal to cost of equity for that particular firm for which we are calculating or doing the calculations. Okay. So So far, we learned that how we can calculate individual cost of capital. So in previous session, we learned that how we can calculate the cost of debt and cost of preference shares. So far today, we learned that how we can calculate cost of equity and how we can calculate cost of retained earning. So these are the four major sources from where the funds can be arranged. So these are individual cost of capital. But in a firm, the funds are arranged from different sources. Okay, it may be possible that 20% of funds you are arranging from debt, 30% you are arranging from preference share, 40% we are arranging from equity, and 10% we are arranging from retained earnings. Or this mix can be different also. It may be possible that we are getting the funds 25% each from all these four sources. It may also be possible that we are getting 50% from debt and 50% from equity. So this combination may be different for different firms. But ultimately, the firm has to bear some cost of capital. And by combining this, by keeping all these individual cost of capital together, we can calculate overall cost of capital. Okay, and this overall cost of capital is known as weighted average cost of capital. We call it WACC, WACC. Okay, we need to calculate this. And why it is called weighted average? Because first of all, we need to take individual cost of capital, and these individual cost of capitals needs to be considered according to their weight in which they are contributing to a firm. Okay, so we just need to multiply the individual cost of capital with the weight, with the percentage in which they are contributing in a firm. And by adding these values, we can calculate WACC. So these are the steps which are visible on your screen. So first, we need to calculate individual cost of capital for specific source of fund. We will multiply this cost of each source, each individual source, by its proportion in our capital structure. And then we add the weighted component of cost to get the weighted average cost of capital. Okay. So if we want to present this weighted average cost of capital in the form of formula, this can be represented with the help of equation which is visible in our on your screen. Our overall cost of capital, that is KO. This is represented by KO or WACC. Okay. This can be calculated by adding different, I said individual cost of capital. So KD we have, KP, cost of preference share we have, cost of equity and cost of retained earning. This individual cost of capital needs to be multiplied with the weight in which they are forming part of our capital structure. So whatever weight of debt is there in our capital structure, the weight of capital debt is multiplied by cost of debt. Weight of preference share has to be multiplied by cost of preference share. Weight of equity needs to be multiplied by cost of equity, and weight of retained earning needs to be multiplied by cost of retained earning. Now by adding this value, we can calculate our WACC or overall cost of capital. So this is the case when all the four sources of funds are available. So it may be possible that we are getting only funds from three sources. So in this case, we will utilize these three parts. So there may be case when we are getting the funds only from debt and equity. In this case also, we can calculate our overall cost of capital using similar equation. So you can see that cost of debt is multiplied by proportion of debt in our capital structure. Similarly, cost of equity will be multiplied by proportion of equity in our capital structure. Now, by solving this equation, we can get our WACC or overall cost of capital when we are gathering funds from two sources, that is debt and equity. Now, let us quickly try and understand this with the help of one numerical example, that if individual cost of capital are given to us, or maybe if we need to calculate this, then how we can reach to WACC, how we can calculate WACC. Okay, let us try and understand with the help of this example. Now see, this is the structure of the company as on 31st December 2024. Now this company has equity share capital of rupees 10 lakh here, okay, and the preference share capital, 15% preference share capital of rupees 100 each for rupees 6 lakh, 13% debentures of rupees 8 lakh, and the overall capital structure has 24 lakh, which is this capital structure is having three sources of funds, that is our equity, preference shares and debentures. Okay. Now the market price of company share is 120 rupees. Okay. And the expected dividend in this case is 12 rupees. Now, which is declared at the end of first year. That means this is our D1 and this is our P0. Okay, the dividend growth rate is 8%. That means this is our G. Okay, the tax rate is 50%, which will be used for our cost of debt. Okay, we just need to calculate WACC using these values. Okay, so since we don't have individual cost of capital in this question, we first need to calculate individual cost of capital for each of these cases. Now there are three sources of funds which are used here. We have preference share, we have debentures, that is debt, and we have equity share. So there are three sources of funds are used by this company is using. So we need to have these three individual sources cost of capital as well. Using this individual cost of capital, we will calculate WACC or overall cost of capital for this firm. So first of all, we will calculate cost of equity using the equation which we have already learned how to get the KE value. So our KE is equal to dividend declared at the end of first year, the price of the share plus growth rate. So dividend declared is 12 rupees, price of the share is 120 rupees, growth rate is 8%. By solving this portion, we get our KE, which is 18% in this case. We also need cost of debt. Cost of debt can be calculated by, cost of debt is given because it was written in the question that these are 13% debentures. So that means the debenture KD is 13%. But since debenture gets the advantage of tax, so we need to deduct the tax value from this. So our KD minus multiplied by 1 minus T. Okay, this has to be used to calculate our cost of debt. So 13% multiplied by 1 minus 0.50. 0.50 is tax rate which was given in question. Solving this equation, we got our cost of debt, that is 6.5%. KP is also given to us as 15%, which was mentioned in the question itself, because it was mentioned in the question that 15% preference shares are available. Okay. So this is how we have individual cost of capital. Cost of equity is 18%. Cost of debt is 6.5%, cost of preference share is 15%. Now using this individual cost of capital, we need to calculate our overall cost of capital. So this can be calculated, or this can be presented in a better manner using this kind of table. So equity shares of 10 lakh rupees are there in the capital structure, 15% preference shares are there for rupees 6 lakh, and 13% debentures are there for rupees 8 lakh. Now, how can we calculate the weight? Weight can be calculated by dividing 10 lakh. 10 lakh can be divided by 24 lakh. This is 24 lakh, the total capital this company is using. So 10 divided by 24 will give us 0.42, which is weight of equity share in this capital structure. Similarly, weight of preference share can be calculated by dividing 6 lakh. 6 lakh can be divided by 24 lakh, and the weight of preference shares are 0.25 in this case. Now, in case of debenture, 8 lakhs will be divided by 24 lakh, and the weight of debt will be 0.33% in our case. So this total of weight should be equal to 1.001. That means this is the 100% calculation. Now, individual cost of capital we already calculated. 18% in case of equity, 15% in case of preference share, and 6.5% in case of debentures. Now we just need to multiply the weight and cost, and we will get the weighted individual cost. So 0.42 multiplied by 18%, we get 7.56%. 0.25 multiplied by 15%, we get 3.75%, which is individual weighted cost for preference shares. 0.33 multiplied by 0.65, this will give us 2.15, which is individual weighted cost for debentures. Now by adding these individual weighted costs, we will get overall weighted cost, that is weighted average cost of capital. We may also call it overall cost of capital, which is 13.46 in this case. So this is how we can use individual cost of capital. We can calculate individual cost of capital, and using this individual cost of capital, we can calculate weighted average cost of capital. So this was all about today's session. So in previous two sessions, we have covered this topic of cost of capital. We started our session with definition of capital, And we learned that what is cost of capital. We learned that why cost of capital is important. We learned how to calculate individual cost of capital for debt, for preference shares, and for both of these we learned that how we can calculate individual cost of capital for redeemable preference share as well as for irredeemable preference shares. Irredeemable and redeemable debt. Similarly, we also learned that how can we calculate individual cost of preference shares. And for preference shares also we learned that how can we calculate the cost of preference share for redeemable preference share as well as irredeemable preference shares. So this is what we learned in previous sessions. So in today's session, we learned that there are different methods, there are different cases for the calculation of cost of equity. There is a case when there is no growth at all, when there is a constant growth rate, when the growth rate is changing with time, when the company is not declaring dividend at all. Then what if the company is using capital asset pricing method, CAPM method, for calculating cost of equity? Okay, so we have seen these different methods for calculating cost of equity. We have also learned calculating cost of equity using the numerical example that I just now discussed with you all. And we also learned that how the cost of retained earning can be calculated. There is no need to calculate cost of retained earning. Cost of retained earning is actually cost of equity only. And how these individual cost of capital can be used to calculate WACC, that is overall cost of capital, or we may also call it weighted average cost of capital. So this is all for today's session. We will meet again very soon in next session. Thank you so much. Till then, happy learning.